All right, we're going to go live, Senseonics earnings. We're going live here, Senseonics earnings. Hey, Greg, what's going on? You got your headphones? Can you hear me? Let me see. You can't hear me? I think I see you. You're on the live, Greg. We could see you. Just can't hear you. I could hear your. Hold on.
Can you hear me now, though?
Yeah, we could hear you. Yeah, we could hear.
Oh, great, but I can't hear you guys. What the hell?
It's something on your end because we can hear you. We can see you.
Neither I can't see you or anything.
That's weird. That's weird.
This just open it up on YouTube, but
All
it's
right.
insane.
Okay, so we're gonna
We've had
react to
such issues.
Senseonics earnings, just to cover what
Oh,
Senseonics.
here I am. I can see myself making a fool of myself on your channel. That's wonderful.
Yeah, we could see you. We could hear you. I just there's something. Maybe you have it. The headset issue, like on
I see you.
Streamyard.
I don't know, bro. It's I just can't have. Hold on.
Can Can you hear now? All right. So we're going to cover Senseonics. I'll tell you right now, Senseonics, if they don't get good earnings, people are definitely going to react to this, and it's going to probably drop quite a bit. If you don't know what Senseonics is, so it's a CGM device. This sector of the CGM sector. So the CGM sector, it's not very crowded, but it is extremely dominated. So it's dominated by three main companies. The three companies that dominate the CGM device is Dexcom, Abbott, and Medtronics. What the CGM does, if you're a diabetic, they place this little device in your interstitial space. Let me see if I could get here. So they place this device in your interstitial space, and it kind of like it doesn't directly measure the blood, but in the interstitial place, it's kind of like blood mixed with other fluid. It takes the blood and it gives you a reading, a glucose reading, and that's why you have to kind of also check it, with a regular device. So they do that like once a week or every couple days. You have to actually prick yourself, take the blood, see the measurement, and see if it's matching what's read on the device. So Dexcom, Abbott does this, and Medtronic does this, and their device, you have to replace it about every 2 weeks. And Senseonics had one where you would replace it every 90 days. And then they got approved in the United States for the 180-day, which was a big deal. So now you can leave that device in for 180 days without replacing it and get a continuous glucose reading. Let me see. So they got that approval. It was a big deal, but the stock still crashed. The stock still dropped, and it dropped for a few reasons. The owner or the president, the CEO, Tim Goodnow, he announced that
The company's remarks include forward-looking statements.
He announced that their revenue out for next year is between 14 and 18 million. And if you look at like the annual revenue, It is way better than last year, but you see in 19 and 18, they've had numbers like that before. So analysts were expecting higher numbers, somewhere in the 30 million range, but he came out and said it's not going to get that high, 14 and 18 million. And he announced it at the same time that they came out with the approval, and that caused the stock to drop. But the reason he did that is because even though they got approval, they're not going to be able to sell their product for a few more months, and they still have backlog of the 90-day device that they still have. So all that combination kind of led to a major drop. So we're going to listen to earnings, and I'll tell you if their earnings, their quarterly earnings, aren't better than the last couple years, then they're going to get a big drop. You're going to see a big drop today.
Thank you, Trev, and thank you all for joining us this afternoon. On the call today, we'll provide an update on our launch plans and collaboration with Ascensia for the recently approved Eversense E3 CGM system. We'll discuss strategic updates in Europe, and we'll touch on our product pipeline. Nick will discuss the fourth quarter financials in detail, and then we'll open up the call for questions. To start off, last month we announced a major milestone for Senseonics, achieving FDA approval of the Eversense E3 continuous glucose monitoring system. This is the third generation product approved for Senseonics and speaks volumes about the leading scientific and technical pedigree of the company. We are very proud to extend the duration of the longest lasting CGM system to 6 months in the United States. Not only is this the longest lasting CGM by over 12-fold, but it also offers patients top tier glucose measurement.
Are you guys able to hear the audio from the presentation?
8.5%. I'd like to thank our team, the PROMISE study investigators and study participants, and the diligent professionals at the FDA managing through the demands of the pandemic, all of whom helped us achieve this milestone. This is a major advancement for patients who continue to seek alternatives to the short-term transcutaneous sensors and for the limited choices that exist in the market today. 6 months of wear, just 2 insertion procedures per year, makes E3 even simpler, more convenient, and less expensive for patients. From our market feedback, it is clear that users have profound interest in a CGM that lasts for 6 months. We believe each sensor wear duration advancement represents a stepwise market penetration and market expansion opportunity. Later in the call, we'll touch on the commercial launch plans we've been developing in collaboration with Ascensia. Before we look ahead, I'd like to recap the successes that we had in 2021. Through significant collaboration, we have transitioned global commercial operations to Ascensia Diabetes Care.
All right, they're announcing the earnings yet? They're just kind of introducing the product.
Is it just me or is it echoing? Like
positive commercial and Medicare coverage policy.
I think it's you.
Awareness of Eversense
fixed it.
Growth through patient advocacy and direct-to-consumer digital marketing campaigns.
So they're just basically introducing the product, Greg. This is the CGM device. If you're a diabetic, and you have to prick your finger every day, check your sugar. So Dexcom Medtronics and Abbott, they created this device that they can put in your interstitial fluids, and it just constantly measures your sugar, and you can adjust your sugar accordingly, your insulin accordingly. And Senseonics came out with a device that you can kind of measure it continuously for 90 days. Then they got approved for 180 days, which is the longest in the market. It's dominated by Dexcom, Medtronics, and Abbott. And they can only measure right now about 2 to 3 weeks.
For 8 million additional covered lives with positive coverage decisions from payers such as Blue Cross Blue Shield of Michigan, Medical Mutual of Ohio, and CareSource, now all covering Eversense. On the financial front, we were able to raise capital to support our ongoing business initiatives with an emphasis on our product development programs. All considered, we have laid a solid foundation to reach the support for more patients and to advance our technology. For revenue, in the fourth quarter, Senseonics generated $4 million, which included $700,000 from the U.S. and $3.3 million from outside the United States.
That's better than much better than last quarter.
From our users, the satisfaction with the Eversense technology remains strong, but the user base was affected by our prior withdrawal from the U.S. sales and marketing efforts, the COVID-19 pandemic, and by the transition
So
of our
I think
distribution
investors
partner.
are going to like that.
The learnings from these
4 million in
factors have
revenue,
informed
that's
Ascensia's
a big
commercial
plus.
planning, and they are working hard to be prepared to launch the E3 system in the U.S. in the coming weeks. As our commercialization partner, Ascensia's key focus in our collaboration is to increase the rate of patient adoption of Eversense. Over the past year, they have been working to gain greater experience in the CGM market and optimize their sales strategy. This has resulted in a newly dedicated CGM commercial organization. Rather than sharing resources and focus with the BGM business, Ascensia is now establishing dedicated marketing and sales functions for CGM. This team is being designed to provide the infrastructure for high patient engagement, determined interaction, and the experience required to deliver the full potential and value of E3 to our users. We are pleased to see this focused commitment to the Eversense product. In the coming quarters, ADC will be primarily focused on transitioning current patients to the E3 system, as well as expanding the new patient and clinician adoption and ensuring continued patient access through the transition from 90-day to 6-month insurance coverage. Significant investments are being made across each category to support programs targeted in these initiatives. We're excited about the E3 commercial launch in the U.S., and it's now approaching. It is scheduled for the beginning of April, which includes product availability and broader marketing efforts. To prepare for launch, Senseonics is ramping manufacturing, implementing product packaging according to the received FDA labeling.
Yeah, so that's what I mentioned before. It's going to take them a bit
channel.
before they're able to sell the product, so they can sell it in April.
Negotiations, Salesforce training to our new label, and preliminary conversations with HCPs to coordinate formal product introductions, as they also continue to build their dedicated CGM team. Right now, in preparation for April, we are leveraging the momentum created by the E3 announcement to prepare the market for launch. A key element of the strategy is to increase Eversense awareness via a direct-to-consumer digital advertising campaign, leveraging population algorithms targeting the diabetes community through Facebook and other social media platforms. We believe that the leads that were generated in 2021 demonstrate the potential to make an even bigger impact in 2022 with the E3 product. Ascensia has plans to ramp up the campaign meaningfully upon our April launch. Diabetes professionals and healthcare providers are also a target audience for specialized marketing. Investments are being made to increase engagements with this group at diabetes trade shows and medical meetings. We expect that patient pull from our DTC marketing will encourage increased engagement with existing providers and for those who are new to Eversense. ADC will initially prioritize resources to penetrate the market in geographies with the highest insulin prescription concentrations, where coverage for Eversense currently exists and where there are active inserters. On the patient access front, ADC is driving with the goal that every patient with coverage for Eversense will receive E3 when they are due for a new sensor starting in April. We are planning for a rapid transition to the new, longer life 6-month product. With the launch of E3, we plan to bolster the patient assistance program to offer E3 to any patient with commercial insurance coverage for a $99 out-of-pocket maximum for their first E3 sensor. That means 6 months of CGM for no more than $99. We see this as an incredibly attractive program to try Eversense. This is a significant investment to drive adoption and initiate product familiarity. It's our expectation that this program can drive increases in the user base as a result of putting both new patients on the product and converting users from other CGM systems. Following a patient's first E3 sensor, the program is designed to provide ongoing assistance, capping a patient's out-of-pocket on a monthly basis. Additionally, Ascensia plans to provide copay smoothing options, allowing patients to pay their out-of-pocket on a monthly basis rather than all up front. And to further ease HCP access, we have initiated a pilot consignment program. This program reduces the acquisition barriers for HCP offices by limiting their initial costs to carry systems prior to their Medicare reimbursement. On the back end, transitioning payer coverage policies from 90 days to 6 months is a process we anticipate will run through the coming quarters. We expect the transition to be fairly seamless with some payers and be more intensive with others as they require updates to their systems. Conversations have begun with commercial payers as well as with Medicare to expedite this transition where possible. In Europe, ADC is making important adjustments to optimize their CGM business. They are working on taking the learnings from 2021 to inform changes and updates in the European markets and drive growth in the patient installed base, particularly in our largest markets of Germany and Italy, where they see potential for Eversense's channel delivery and competitive tender preparations improve as ADC designates resource to provide a higher touch patient experience. In Germany, Ascensia is implementing this patient-centric product delivery strategy to provide users and HCPs with an improved product experience. They are transitioning from an indirect distribution model and increasing their dedicated Eversense resources. They have already implemented Eversense internal sales specialists to support patients from prescription to insertion and have begun to provide patient training. This offers greater sales process control for Ascensia with our CGM. Regarding the product pipeline, where we continue to make strides to advance CGM innovation, the E3 system is currently under review by our notified body in the EU to achieve a CE mark. This evaluation is progressing, and we are hopeful to launch this system in Europe in the third quarter of this year. We would enable the latest generation to be available globally, which would allow us to turn to greater realization of manufacturing and operational efficiencies, and to bring our product with lower calibration requirements to the users in Europe. In our research and development efforts, we have shifted our focus to the advancement of our one-year sensor. Recent pilot studies have provided valuable information that we continue to incorporate into the technology design. We look forward to sharing some of these results at the upcoming ADA meeting in June. We are progressing with the sensor design and continue to plan to submit for IDE approval from the FDA in the second quarter, which would enable the start of a pivotal trial in the second half of this year. Our current plan is that once this one-year sensor study is approved, we will focus on submitting the iCGM designation for E3. We're excited about the potential for patients to be able to integrate our lifelong Eversense with the wider variety of delivery devices that are available. In addition to the advances in the sensor longevity, we're making improvements in the interoperability and remote patient monitoring for Eversense. We are working with several partners in the diabetes space to provide real-time CGM data to the connected apps through both the Eversense Cloud and directly from our transmitter. And we'll also be providing the CGM data through Apple and Samsung Health. I'll now turn the call over to Nick to go over the details of our fourth quarter financials.
Thank you, Tim, and good afternoon, everyone. In the fourth quarter of 2021, total net revenue was $4 million compared to $3.9 million in the prior year period. U.S. revenue for the fourth quarter was $700,000, and revenue outside the U.S. was $3.3 million. Gross loss in Q4 2021 was $0.5 million, a decrease of $3.1 million from a gross profit of $2.6 million in the prior year period. The decrease in gross profit was predominantly related to the increase in cost of goods sold due to the sale of previously written off material in 2020. Fourth quarter 2021 selling, general, and administrative expenses were $5.8 million, a decrease of $2.4 million compared to $8.2 million in the prior year period. The decrease was primarily the result of a decline in salary and personnel costs from the reduction in sales support due to the transition to Ascensia for the commercialization of Eversense. Research and development expenses in Q4 2021 were $7.7 million, an increase of $3 million compared to $4.7 million in the prior year period. The increase was primarily due to the expansion of our R&D headcount, an increase in clinical studies, lab supplies, and an increase in outside expenses to further advance our product pipeline. For the 3 months ended December 31st, 2021, operating loss was $13.9 million compared to $10.3 million loss in the fourth quarter of 2020. The decline in the company's share price at the end of the fourth quarter as compared to the company's share price at the end of the third quarter of 2021 led to a significant non-cash gains in Q4. As a result, total other income increased by $189.7 million compared to the prior year period, primarily related to non-cash charges resulting from the accounting for embedded derivatives and fair value adjustments related to the company's financings, including the 2023 and 2025 notes, along with the PHC 2024 notes and Energy Capital Equity Line of Credit. As required by U.S. Generally Accepted Accounting Principles, or GAAP, we mark the value of these instruments to market for each reporting period, and the change in these values are recorded as non-cash charges to the income statement. Each quarter, the value of these non-cash gains or losses will vary based on the volatility in the company's share price. So generally, as share price increases, we incur a non-cash loss, and as share price decreases, we recognize a non-cash gain. For the 3 months ended December 31st, 2021, total net income was $84.4 million, or 19 cents per share, compared to a net loss of $101.6 million, or 41 cents per share, in the fourth quarter of 2020. Net income increased by $186.1 million due to the accounting for embedded derivatives and fair value adjustments previously mentioned, partially offset by a $3.7 million increase in loss from operations. For full year 2021, our net cash used in operating activities was approximately $56.1 million, below our full year 2021 guidance provided at the beginning of the year. Cash flow from financing activities for the year was $220.1 million, of which $5.3 million of cash outflow was related to employee tax liabilities for restricted stock units, or RSUs. In 2022, RSUs that have vested thus far have been transitioned to a sell to cover for employee tax liabilities, saving the company the related cash outflow. The executed sell to cover taxes transactions were prearranged and automatically executed to uncover employee tax obligations that arise upon the vesting of grants, which are generally tied to tenure or other milestones, such as the FDA approval of the E3 product in the U.S. As of December 31st, 2021, cash equivalents, short and long-term investments totaled $181.8 million. Considering our current patient installed base, the E3 launch timing, current product inventory forecasted to meet our Q1 demand, and the transition of payer coverage policies to accommodate 6-month reimbursement in the U.S., we expect our full year 2022 global net revenue to be in the range of $14 million to $18 million. As Tim mentioned, the first quarter will be a transition period in the U.S. as we shift entirely to the SENS E3 system, which is expected to launch in the second quarter. Given current inventory in the channel, we expect first quarter 2022 revenue to be well below fourth quarter 2021 revenue. Additionally, full year 2022 revenue is expected to be significantly weighted towards the back half of the year, with the second half accounting for approximately 75% of total revenue. And for the full year, OUS revenue is expected to be greater than US revenue, with OUS revenue accounting for approximately 55% of total revenue in the year.
Well, at least we know they're very transparent.
Policies occur from the 90-day
Yeah.
to 6-month product. We expect gross margins to approach break-even in the fourth quarter. For full year 2022, net cash used in operations is projected to be in the range of $55 to $70 million. We expect the majority of expenses in 2022 to be for research and development for ongoing feasibility and pivotal clinical trials for additional products in our pipeline, including the start of the 1-year pivotal trial subject to IDE approval. With that, I will turn the call back to Tim.
Thank you, Nick. As we transition into 2022, we are excited for the E3 commercial rollout in the U.S. during the second quarter and the expected later launch in Europe later this year. This next generation of product is an exciting advancement in diabetes management. Our patients and providers have been waiting for such a product, and we are eager now to bring them the benefits of the world's longest-lasting CGM system. Ascensia is steadfast in their commitment to CGM and the SENS product, investing millions to drive awareness and access for the product this year along with launching a new dedicated CGM commercial organization and building a dedicated sales force in the U.S. This investment is ramping meaningfully and demonstrates their continued support to our partnership and the product. Before we open up the call for questions, I'd like to take this opportunity to thank Marisol Penlilio, our Vice President and General Manager of Global Commercial Operations, for her over 7 years of establishing and leading the growth of Eversense and her commitment throughout her career of improving the lives of people with diabetes. I and the whole Senseonics team wish her the best in her retirement. Thank you for your time today. Also joining us for questions is Mukul Jain, our Chief Operating Officer. Operator, let's open up the call for questions.
Thank you. We will now begin the question and answer session. To ask a question, you may press star then 1 on your telephone keypad. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then 2. At this time, we will pause momentarily to assemble our roster. Our first question comes from Chris Pasquale with Guggenheim. Please go ahead.
Thanks, Tim and Nick. So, the revenue guidance, which you guys laid out at the time of the approval announcement was certainly a little bit surprising relative to where consensus was, but you guys just walked through a lot of the moving pieces that you're dealing with this year between the transition to the 180-day sensor, inventory drawdown, the patient assistance program. So it would be helpful to understand some of the underlying assumptions behind the guidance. And if you can, give us a sense for, where do you expect to be at the end of the year in terms of the number of patients who are on a sensor? What percentage of patients in the U.S. do you expect are going to need to take advantage of that patient assistance program? Just anything around those assumptions would be helpful.
Sure. Thanks, Chris. Well, we're certainly excited to be where we are. On the cusp of launching this great new product for is a very exciting time. With that said, we certainly would like to be further. We recognize that the impact that COVID had on the organization, as well as the delay from the U.S. approval, also related to COVID with the FDA, certainly has impacted, the rollout and progression here in the United States. But we do believe that we have all the pieces in place with Ascensia, their commitment to the space, and the programs that we've talked about. We think are very, very meaningful. We're not going to speak to patient count, as there still do continue to be a lot of moving pieces associated with it. But as you've heard, we do start with a basis of about a little bit over 2,500 patients in Europe that continue to be on the product, and a little bit over 600 here in the United States. You will recall that the previous efforts, we put about 4,000 patients on the product in a full year. I don't anticipate in this partial year we'd be able to approach that, but we certainly are looking to drive as many new folks on the product as obviously we can get access to and have industry. We do expect there to be reasonable use of the assistance program, as is typical, especially early in the year when deductibles haven't been met. But at the same time, the attractive thing about having a 180-day product is once the patients do come on, even with some financial support up front, we're able to make to them, and they are able to make to us, a pretty significant commitment. So 6 months of using the product, without turnover opportunity. So we believe that they're going to get a lot of value out of that. So as Nick said, we do expect that a little bit more than half will still be coming from Europe, but that does indicate that there's pretty good U.S. growth behind it, which of course is a very important market for us. And also, as Nick said, the majority of the revenue is coming later in the year, really driven by this transition in Q1, where we essentially draw down all of the 90-day inventory in the U.S. and really start clean here on April 1st, the 180-day product. So I hope that helps.
Yeah, that is helpful. And I just want to follow up on that last point you made, because the back half waiting and the waiting towards international, is there any risk of disruption internationally? Let's say you do get the CE mark and you're in a position to launch that product in the third quarter. Is there the potential that you could see a drawdown of inventory of the old sensor, or the need to book contra revenue for inventory that's no longer going to be sold, that could end up actually hurting the international business later in the year, the same way the U.S. business is being held back early in the year?
Yeah, we're going to work to very much minimize that. The timing is being monitored very closely. As you'll note, especially here in the first quarter, we are being very judicious with the amount of product that we put into the channel to really minimize the likelihood that should happen. In Europe, they are on the 180-day, 2-time-a-day calibration product. We'll transition them to the 1-time-a-day calibration, and it's our expectation we can manage that quite tightly, and it's certainly a shared objective between the two organizations.
Great, thanks.
Our next question comes from Marie Thibault with BTIG. Please go ahead.
Hi, good evening, and thanks for taking the questions. I wanted to follow up here on the question around kind of patient volumes. I understand you can't give us sort of what you're thinking of expectations to end the year, but I did want to try to understand the recent fall off a little bit better. Understand obviously COVID and some of the transitions have been an overhang, but how recent was some of that fall off? I'm just kind of trying to get at the question of how easily won back some of these patients and prescribers might be.
Sure. In all candor, the biggest impact to the organization was we pulled the ability to fund the commercial organization at Senseonics. So much of that loss really happened in the late 2020 time period, and certainly built into the start of 2021. The continued dynamics with COVID certainly contributed to that. So there was a pretty significant contribution to that pullback in all of 2021.
Okay, fair enough. Thank you for that. And I did want to also understand, you called out the 8 million additional covered lives that win. Where are we in terms of total covered lives, I guess, for the 90-day product? Just trying to understand what kind of the starting base is as we head into this payer transition for the 180-day.
Sure, we're still, we're still counting about 210 million covered lives. Obviously the 365-day product is important for us, and the IDE approval will include the pediatric population in the clinical testing. So that's obviously a big piece. And then in addition, we still continue to work with Anthem and United that still hold the E&I on EverSense. And we're certainly hopeful that the 180-day product will help move that forward with them.
Okay, last very brief one, and thank you for that, Tim. On the MDR process in Europe, is that adding any extra complexity? What are you hearing from your notified body, or what gives you confidence in the 3Q timeline? And Thanks again for taking the questions.
Yeah, it is a very good question. Yes, there absolutely is impact in the transition to MDR. We have been in it quite some time. There have been much more extensive reviews than would have been typical without this new regulation. We are in pretty constant conversation with our notified body, and just given where we are and the amount of material that was submitted and the review cycles, we do feel that we're at the point that we can forecast this Q3 time period for us to be running with it.
Thank you again.
Our next question comes from Matthew Blackman with Stifel. Please go ahead.
Hi, this is Colin on for Matt. Congratulations on the recent E3 approval. I just had a question around the reimbursement progress you've made. You mentioned Blue Cross Blue Shield and a couple other payers and expanding to 8 million covered lives. I was wondering, how has the progress gone really with the main holdouts at this time, and what kind of time frame are you thinking for reaching a higher number of covered lives, whatever that may be? Thank you.
Well, certainly the biggest one that's frankly in our control and right in front of us is the pediatric indication. So we will begin that testing here in the second half of the year. That's of course an important constituency for for people with diabetes. So it's high on our priority list, and the 1-year product is a great time for us to do that. The two remaining are two of the largest, unfortunately, but as it's been typical, especially in the space with diabetes technology, they tend to be much later in the approval process because of their size. So, we certainly would have hoped that we would have gotten coverage. I don't know if COVID has impacted that, but I do think with the more, longer duration, more compelling product, there's going to be a lot more push from their users to push for it. So, I certainly hope that in later this year, next year, we'll be looking at a point where they'd be strongly considering coverage of the product.
Thanks. And I have a couple on the pilot at-home insertion program. How's the reception been so far for that pilot, and what should we be expecting in 2022 for the expansion beyond the initial limited geographies, and will it have a visible effect on the reimbursement profile of D3 this year?
We're certainly excited about it. I'm not ready to speak to a larger rollout at this point because it still is, still in a test configuration, if you will, in the Houston area. But it's, it's a compelling opportunity and one that we have certainly talked about, in micro sites, pushing out to larger geographies. The way that it works is there's a mobile, typically it's a nurse, an NP that will come to visit people at their house and actually do the insertions and removals. So it's got a great user benefit, but obviously we want to make sure that we keep it, we learn everything from the early startup and make sure that the process is going swimmingly for everybody before we expand it. So a little bit too early for us to make broad conclusions, but we're excited as one more opportunity to look at for new insertion approaches.
Thanks. Appreciate the questions.
Our next question comes from Alex Nowak with Craig-Hallum Capital Group. Please go ahead.
Hey everyone, this is Trent on for Alex. I wanted to dive a little deeper into the guidance here. How does the change in guidance for 2022 modify the ramp into 2023 and 2024 that was provided on the Ascensia call or partnership call in 2020?
I don't think we're in a position to answer that here, Trent. That was done, coming up on 2 years ago. At this point, we did anticipate that we would have had the review with the agency last April. I would anticipate, it's our expectation, obviously, that much of the focus is going to be in the U.S. and the commercial activities will focus on that. It continues to be a very exciting space that we're in, and there is a lot of interest in the 180-day product. So we're encouraged by the ramp future, but I don't want to rely on something that was done, pre-COVID at this point, and pre the COVID impact on the FDA approval to look in the future here on this call.
Got it. That makes sense. If I could ask another one here, with Libre 3 and Dexcom G7 coming to market, how do you see Eversense being positioned, and how will adoption be different this time than when 180-day in Europe was fighting the G6?
So as I'm sure you're fully aware, the market dynamics are different. It's predominantly Libre, or much more predominantly Libre in Europe. Obviously when the full function CGM comes, that's going to have an impact, I expect. There'll be more, noise and activity in the transcutaneous sensors as they compete for a position. At the end of the day, it's the patients that win as the technologies get more mature, with more flexibility and more capability. And what that does is it brings more and more people to the CGM testing family, which is a big opportunity for Eversense. We still continue to be the only implantable, obviously not only the only implantable that's commercial, but certainly with the U.S. approval. So we feel that we have a pretty good lead in that segment, and that as our duration expands, as I said earlier, that really drives greater and greater interest in participation. So at the end of the day, more interest is a bigger pool, and we certainly are going to continue to drive for our fair share of that increased pool size with the implantable sensor.
Okay, appreciate the questions.
Our next question comes from Jason Bedford with Raymond James. Please go ahead.
Good afternoon, and thanks for taking the questions. I wanted to ask about the patient assistant program. So I guess early on you mentioned E3 is less expensive for patients. Were you referring directly to the patient assistance program there?
No, I mean, the biggest outside of that is really the, any insertion expense, right? Just got cut in half from 4 a year to 2 a year. That's of course the biggest driver.
Right. Okay. But reimbursement is still.
Yeah, he confused them. Absolutely.
Yeah, we haven't seen
Right.
reimbursement, as you know. We continue to see in the range of about $10 per day in commercial pay. So, there is some variance from payer to payer, and Medicare is a little bit higher than that.
Okay. And then just on the $99 patient assistance program, can you just put some context around it, meaning kind of what did the average user pay out of pocket in 21? What do we compare that 99 to?
Yeah, so there's a pretty good variation. One of the key differences, I restrict this to people that have coverage
in a good mood today.
Our bridge program. We did get a lot of utilization for people on United and Anthem that didn't have coverage. So that drove, I think, average utilization was around $600. I think without those that have no coverage, this will be quite a bit less. So a couple $100 perhaps.
Okay. And I guess just, I haven't fully thought through this, but maybe can you explain how this program impacts your revenue? Because I have to think through the billing, but I'm just kind of curious as to the impact of this program on your and Ascensia's revenue.
Yeah, so it is any revenue that that is not collected as part of this obviously is an offset. So we'll continue to report, as we have been, net revenue. And although there is some expected, it is an investment that we are jointly making with Ascensia in the space to bring people to try the 180-day product. But at the end of the day, it is a net revenue reduction, which is part of the basis for the guidance that we built.
Okay. And just the basis for the guidance of 14 to 18, that assumes that the patient assistance program lasts 6 months, is that right? Or the full year?
Well, it lasts for the first sensor when someone comes on, Jason. So, right? It could even go into next year for the second half starts.
Gotcha. Okay. That's helpful. And then just on the ICGM submission, I may have missed this, but this is after you start the 365-day trial?
We want to get the 365 IDE approved, Jason, right? Given the size, the obvious opportunity for the one-year product and the pediatrics, that's our regulatory focus at this point. So not after we start the trial per se, but certainly after we get the approval for the IDE.
Okay. And then maybe just for Nick, you broke up for me at least a little bit on the cash burn. I caught the upper end of 70. What was the lower end?
Yeah, 65 to 70 million for the year.
Okay. Okay, thank you.
You're welcome.
This concludes our question and answer session, as well as our call for today. Thank you for attending.
All right. So, Greg, you kind of just been introduced to the company, right? Do you have a good background on senseonics?
I definitely don't have a good background. I do remember you spoke about it a little bit, and pretty much what was added here. So yeah, not enough. But
okay. So the first thing, though, I did want to point out, I remember I made a video, this video here, senseonics, will it be acquired? and I wanted to address something. One of the comments the guy wrote, the guy claimed to be a YouTube lawyer or something. He said, it's not honest to dump free shares. It should have waited until March 1st. Anything unaudited should wait. Everyone had the right to sell on the news and buy back. That's how the game's supposed to be played. So he had like 10 other comments, and he's saying he's a lawyer and that Senseonics did illegal selling. But I had made a video, you know, I don't know what kind of lawyer he is, because his first claim is that we should have been allowed to buy the news or buy the rumor and sell the news. So if you're a lawyer, how is that, you know, that's not going to hold up in court, right? You can't say, hey, I'm suing Senseonics because they didn't let me buy the rumor and sell the news. So that was like the first red flag with the guy. Then the second thing was there was no research, and I made a follow-up video to answer his claims, and they reiterated it on the call here. So when Senseonics got the approval for the 180 days, they got scheduled bonuses, right? And if you look at what is it, the 12D or something, their scheduled bonus was immediately followed by a small sell-off to cover the taxes on it. So everybody was like, oh, they're selling, they're doing this, but nobody did any type of, you know, research. I mean, that lawyer guy, that was his claims, and you know, and that's common, right? You know, you let me see here, so insider. So we have here insider selling, right? This was all these guys, 1, 2, 3, 4, 5, 6, all these 6 guys sold immediately after they got the 180 day, right? And the guy, the YouTube lawyer, was like, oh, that's illegal, right? So I was like, man, like, you just got to do research. Just open it up. And if you open up the 10K, you see that they were granted this. They acquired stock, right? He didn't look that they acquired stock. And then they immediately sold a small portion to cover the tax. And if you look at the, let me see the 8K here. So that was the case for every single one. They all acquired stock. They were all granted stock because of the 180-day approval, and they sold a small portion, very small portion. And if you read it, it shows that it was done to cover their taxes on the granted stock. So that was the first thing they mentioned. The second thing they mentioned, which I mentioned in my video, was that next year, their R&D expense is going to go up a lot more.
Yes, they said so, yes.
Yeah, they said that significantly. And I said that in my video, and I said, so, because one of the main questions I got, right, if they got this 180-day approval, then why did it crash immediately? And I said it crashed immediately because Tim Goodnow announced that their revenue was going to be 14 to 18 million, which he announced right now again. And someone asked, you know, someone said that they expected it to be higher, but they're not selling their product yet. That's what investors didn't have kind of, or some of the investors, they didn't think about. They said, oh, this product is approved. They should be selling it, so they should automatically get more revenue. They're not going to be able to sell the product until April. There's a transition, and they still have a backlog of the 90 days. So they have to transition their current patients to the 180
Wait,
days.
the FDA on Q3. The FDA approval on Q3. Yes. Shouldn't be that happening on the current device?
So the current device monitors you for 90 days, right? So let's say I'm a Senseonics customer.
So, wait, simple question before we get into the details.
Yeah.
The question is the device. What were they referring to when they said Q3 FDA approval? Which device?
They're referring to the 180 day. So right now, right?
The E3 one.
Yeah, the E3. So right now, if I'm a Senseonics customer, I have that device in my interstitial space, and it's monitoring my blood sugar for 90 days. After 90 days, I have to replace it. And Dexcom has one that's about 2 weeks, and Abbott has one that's about 2 weeks.
That's the one they're sending the nurses right now to apply to patients in the test period, the trial period.
Yeah.
Correct?
So so all those patients that are on the 90 day, they're going to start transitioning them to the 180 days. So now they can keep the device in for 180 days. Which is
slowly but surely it will. I'm going to ask you as somebody who comes from the industry, from the healthcare industry,
Yeah.
is that device potentially, again, what we're seeing here, that they're trying to build up a longer duration in which the device actually stays with the patient, provides still a long distance monitoring, correct?
Yeah.
And they essentially trying to get to the point where the client simply receives the product, uses it on his own, and they monitor and adjust accordingly, correct?
Yeah, so they will never be able to insert it on their own, and that was the biggest setback, during COVID, right? Because if you have Dexcom, they can mail you Dexcom and you can self-insert it. Then when COVID hit hard and all simple procedures were halted, Senseonics got hit very hard because of that, and you see it in their revenue. You see it during COVID, like the big drops here.
Well, I've seen it, but I would say it's very difficult to justify it one way or another because of everything that was happening in the market itself. So that could have been just a side effect. If you look at a lot of companies, pretty much they've gone through a reset. They've gone through a peak and a reset. And if your company deserves what was happening throughout COVID, you'll build it up relatively quickly. If not, you'll fall. Pretty simple.
Yeah. So kind of like recapping some of the numbers, their revenue increased, which is what you wanted to see. So they increased their quarterly revenues. Now, their first 2 quarters of this year aren't, like they mentioned, aren't going to be super high. And that's what I mentioned. I reiterated that in my last video. I said, you can see that the results, the fruit of this labor in the late quarters of 2022. So in the late quarters, they'll have more sales from the 180-day, and you can see higher revenue. But these next 2 quarters, it's not going to be super high, and they have a backlog of items that they have to get rid of. And then a potential catalyst. Somebody was asking about a catalyst. A catalyst for second quarter, if they get approval for them to start testing for the 365. The 365 is what I am most bullish on and why I'm holding. I'm waiting for the 365. This 180 is good news, but my thesis, my bullish thesis is depending on the 365, because they're going to be, when they get that approved, they're going to be,
provides quality of life. Pretty simple.
Quality of life. You put that device once a year, and they've already proven to be accurate. So MARD is kind of the measurement. It measures your reading on the device versus actually pricking blood, on your finger and looking at the blood glucose on your finger blood, right? So you're getting directly the glucose from your finger, and you're looking of how it's calculating it. And this MARD kind of gives you a range of how accurate it is. 180-day is already more accurate than Dexcom and Abbott, and they're just as competitive. So they can prove that their device is going to be just as accurate as the big boys, but they're not. The big boys have been in the game a long time. They're dominating. Dexcom got hell of a lot of money, and they have so much free cash flow, and they advertise. You see, they got like the Jonas Brothers, so they're dominating the narrative. But I think as slowly Senseonics is peaking in, they got their 180-day, and if when they get approval to start testing for the 365, then that's going to be a big changer. So somebody asked me about price targets and all that. I say, look, this is based off of my research, my assumptions. I'm not using anyone else's assumptions, not even like other analysts. This is strictly my assumptions. I did a DCF based on my assumptions, so you have to be confident and do your own due diligence. But I'll share my DCF here. Hold on. So this is my DCF here, and I'll go up a little. So when I do my DCF, I like to have a upside assumption, a base assumption, and a downside. So downside, if they didn't get FDA approval and revenue just started dropping, you see the changes here. So these are, I did it based off of percentage of market share. When I did this FDA approval, I did their revenue, but the biggest thing is based off the percentage of market share that in the CGM, since it's dominated by only a few companies. And for my downside assumption, if I was extremely bearish, like based off their free cash flow, these guys are just way overvalued, right? For my base assumption, 16 cents. And my bullish or upside. Never bet on one horse. Absolutely, of course not. No. Jordy said, never bet on one horse. Never that. No, absolutely not. And you know, when I'm bullish, if I'm like bullish on a company, that might mean like 5% of my portfolio, you know, and I divide it by multiple stocks. So that's definitely a good point, Jordy. No matter how bullish you are, if I'm extremely bullish and extremely excited, I personally don't bet at all, but there's some that do. I mean, look at Dave Lee. He went all in on Tesla. There's some guys that go in all on Palantir. Everybody's different. You know, you can't say one person is more correct than the other. I mean, it's whatever the person's comfort level. So my assumptions, if they're successful, and this is assuming that they get the 365, they start selling the 365, they penetrate the market share in the United States. Right now, they're like 0.0 something market share in the United States. So as they start to penetrate the market, I believe that they should be trading at $8 if, you know, once they start growing, which doesn't sound like a lot.
Have
Especially,
you known them talking to any major countries that are interested?
I heard that they want to start marketing in Asia market, and that would be huge. The Dexicom dominates Asia, but you know, like that's a sense. So they partnered up with Essentia. Essentia pretty much takes care of all the marketing. If you don't know Essentia, if you ever bought like the glucometer sticks and all that, they sell all that. They're like the number one company that does all that. And I could share that. Yeah, absolutely. So that would be that partnership is what's going to help them get into the other markets. But yeah, it is a big difference. But I went extremely optimistic on my bullish here because it's a big difference because, you know, for them to go to the upside, there's a lot more assumptions that they're going to grow pretty rapidly and that the 365 is going to be successful. So yeah, there's a lot of assumptions built in, and it's extremely optimistic. And that's why even though I'm bullish on it, I mean, I'm still like, I don't think I have more than 5% of my portfolio in this company. But no, I got in early. I got in at $1 something. So, you know, I could have sold like when it was 5 something, but I just want to hold it for the long term. But that's kind of where I'm at with this. The earnings were good. There was some disappointing news, I guess. I think on their gross income was a lot lower than expected. But other than that, their net income, you know, I know they had some tax break stuff, and the net income was good. Revenue, please. Revenue, because so 2022, which is this year, right? They're just rolling out their new product, right? So their new product is the 180-day. That's what's going to help them actually, you know, gain some more market share, hopefully, and sell more. But the problem is they have a backlog of the 90-day that they have to kind of like either lose or, you know, they can't continue to sell their 90-day if they have their 180-day. And then there's going to be a transition where they have to get their current patients that are on the 90-day onto the 180 days. And that's going to have a little bit of challenge because, you know, with insurances, they have to kind of like approve it. And they said it, I think Tim Goodnow said it, that half of it is already done. It's going to be a smooth transition. And the other half, he said, is going to be a little bit more challenging. So it's basically like a grace period, right? There's a period of time where they're getting this new product. There's not going to be any major increase in revenue, and it's still going to be some loss. Like let's say, you know, I buy I have something for my store, and it has like 3 wheels, and it's really good, and I buy 10,000 of them. I've sold 5,000 of them, but I just made a better product. It's the same one, but it's got 4 wheels. So those other products that I have in my shelf, I may not be able to sell it. So there's going to be a loss there. So they're anticipating that they're going to have some like backlog loss, and they're also anticipating a little bit of delay during the transition, getting insurance approval to stop paying for the 90-day and start paying for the 180-day. So that's kind of the reason they're a little bit conservative. That's why Tim Goodnow was conservative when he said 14 to 18 million. And that's why that price dropped drastically after he made that announcement. If right after he made the announcement, it dropped quite a lot because people were expecting at least 30 million in revenue. And, when Tim Goodnow said, you see here, the big drop just off of a sentence that he said, it was up here, 390, and then dropped as low as $1.37. And now it's about $1.93 or whatever. So that was the reason for the drop. And that's the reason for anticipated lower earnings for 2022. You should see the bulk of their earnings in revenue in late Q3 and Q4. And you should see, though, a catalyst, a spike. You should see a spike if you're a swing trader, you're probably going to see a spike in Q2 if they get approval to start testing for the 365. Now, what does that mean in Q2 if they get approval for start testing to the 365? That means towards the end of the year, they're going to have their candidates, and they're going to go through the same process they did for the 180-day, and it's going to be for the 365. Obviously, that's going to take longer because if you have a pool of 60 people that you're studying and you do your blind studies and all this, every single person, as they go through the whole study is going to take a year because it's a 365-day device. So it's going to be a while. I would probably say 2024, they would, roll out the 365 because if they get approval in Q3, then Q3 of next year, they'll be done testing those candidates. So, but the 365, I think, is going to be big, man. It's going to be big. They got the 180-day here in the U.S. They've had it in Europe. They're having good sales in Europe. So that's it. It's a cheap stock. It's $1 something. So even if you say, okay, you know what, I just want to risk a couple thousand shares and see what it does. To me, the risk reward is excellent, right? Your risk is dropping, let's say, $1 or whatever. And your reward, it's there's a big upside reward for holding on to this stock. What I think. So I like the risk reward. I'm comfortable with the risk reward.
In your opinion, is there a Tesla scenario, so to speak, in which they absolutely dominate, they take over globally and become the go-to product, and they absolutely explode? What do you? How?
I don't think that's possible. No, not with Dexcom. Yeah, no, not possible. Dexcom right now is dominating. Dexcom has a lot more money. They have longer reach. And if I think, and so the difference between Dexcom, Medtronic, and Abbott, Medtronic and Abbott also has this device, but Dexcom solely focuses on this device, on the CGM, and they dominate the market share over 30-something%. Medtronic and Abbott has the rest. But I think, in my opinion, if Senseonics started gaining more market share and they started getting bigger and bigger, Dexcom is going to use a lot more money in their R&D and become a lot more competitive and, probably try to have their own long-term device, right? So I think if they get the 365, they're going to be ahead of the pack. But Dexcom has just way too much money to watch another company like Senseonics just come and dominate like that. I don't think it's possible.
Gotcha.
So yeah. So basically the 365 testing FDA in Q2. FDA, they're actually going to apply to be able to start testing in Q2 of 365, and 365 FDA approval is approximately Q3 or Q4. So they're going to start testing this year, possibly, if they get approval. They're going to sign up for approval in Q2 of this year, 2022. And if they get approval, Q3 of this year, they'll start testing. And that test will take no shorter than a year because it's a 365-day device. So Q3 of 2023, or Q4, they may have completed their testing.
Maybe
if there's no delays, have completed their testing, and then it still would take a little bit of FDA approval time. So that's why I said 2024 is more realistic of 365-degree. I don't know why I keep saying degree, but it's 365-day approval. Yeah, it's not going to be Q3 or Q4 now.
Yeah, you could be this. to me it seems like it's going to be more of a trade situation where you can trade it up and down multiple times, I think. And
yeah,
but
and that was my strategy, right? So look, I got in at $1.80 something, $1.90 something, and I had like a large position. And my strategy was swing/hold. Like I was always gonna hold. Yeah, I was always gonna hold long term. But on this day here, I was expecting a crazy spike. You see, so I'll show you what I was expecting.
You know, I'm a great advocate for that sort of way of trading / investing, because it's great. This way, even when that possible scenario of actually getting approval, everything just somehow, and we know things can happen unexpectedly, things can run faster than you expect, better than you expect. You always want to have that backup position already in the stock if you really believe in it, obviously, if you have the conviction.
Yeah.
So I'm absolutely behind you on that one.
Yeah. No, I like continued income, right? So it's like poor man covered calls, right? The same thing. You own the position and you sell a couple calls just to generate weekly income. So I treated that this way, right? So I had the shares that I was comfortable buying, and then I had extra shares that I was swinging. And you see, I did good here. I was holding, but on this day when they made the approval, I was expecting to sell on this white line where I had here.
Right.
This was my price target where I was going to sell.
And you waited.
Yeah, I waited, and then I just sold some of my position as it just started to crash for a gain, but not as big gain as I anticipated. And now the rest that I have, I'm like break even, but I'm fine with it because that's the amount that I was willing to hold for the next couple years, anyways. So yeah, it's just it was disappointing to not see a crazy spike, but it is what it is. I think the patience that Senseonics have would damper on Dexcom. I'm trying to create a long-term device. Yeah, I don't know. There's people that are pro Dexcom. When I started doing research on like Dexcom, they have like a lot of forums where people were complaining of the accuracy issues with Dexcom, false alarms with Dexcom. But those are all things that Dexcom they have the ability to fix. Don't get me wrong, Dexcom's a solid company. I mean, I like Senseonics, but I like it more because I feel like I'm getting in early. And if you look at Dexcom, the move they made, like I feel like if I get in now, I mean, I haven't done enough research to know how much upside they have, but let's see here. If we go back when Dexcom first, like imagine like I was an investor. Let me put a monthly here. Patents, not patience. Yeah, maybe I said it. Yeah, Brandon, it's live. I'm gonna make mistakes here, man. If I said patents or patience, I don't know what I said here. So imagine if you were an investor down here. Look at Dexcom, $10, and then it just made this crazy run all the way to $659. You know what I'm saying? Like, so for me, like, okay, like let's say you were bullish on Dexcom. Dexcom. I'm sorry. I have a habit of saying Dexcom. It's Dexcom. So imagine, bro, I don't know why I keep doing that, but like imagine you were bullish on Dexcom and you get in, in this spike here, you've lost about 40%, right? But if you're bullish and you have like whatever upside, then you really don't care. So yeah, so for me, I like Dexcom, but I think if I wanted to get into Dexcom because it's a good company, I would sell a put at 340. If you're still bullish on it, I would sell a put at 340 and see if you get filled. If you don't get filled, then at least you still keep the premium. So that's how I'm approaching Dexcom. I still do like the company. I think it's a good company. But Senseonics, I like it because I feel like it's early. There's potential of upside. There's risk, obviously, but that's where I'm at. Secondly, they already anticipated 90 days. Yeah. Why wouldn't they just set the revenue expectation target of 2022 as it was now instead of 30 million and now deduct half of it? No, so the 30 million that was expected was done by analysts. Analysts expected 30 million, and I'm assuming they expected 30 million because if you go back here, 2019, they made 21 million, right? This was right before COVID. They made 21 million right before COVID. So if you're an analyst and you're saying, okay, they were on the up and up. In 2018, they made 18.9 million in revenue. In 2019, they made 21 million. This big drop to 4 million was because they got shut down by COVID. And as an analyst, you're saying, okay, they were on this uptrend. I expect them to beat the 21 million now that they're fully functioning, and maybe make more because they have a new product in 2022. So that they came up with 30 million, which doesn't seem too far-fetched, right? If you made 21 million
More
with this,
so. And
yeah,
I'll add another thing, if I may. People tend to neglect to forget everything. It doesn't matter what you're producing. If you are shut down, you improve your production line, your production ability. So once you get back to production ability, to actually being online, let's say your prior was 100, your prior 100%. Will become essentially it will appear as 80, right? And then you'll have that growth, and you'll be although again in percent it will be looking as if you're making less, as if you're slowing down, but in reality you're producing more product due to the upgrades you made during that time.
Yeah, so let me see. I would argue that based on the current revenue, Senseonics is at fair value. I do expect them to beat earnings this year, though. I am hopeful for Q3 quarters. That's, I mean, and you know, so your mindset though is what what a lot of analysts' mindset had. So your mindset isn't too far fetched, right? That's what they had in mind, right? And they're basing it off of, they made 21 million, so now they're fully back, they're fully selling their products, and they got a new product. Why can't they beat this and you know, maybe be higher? But Tim Goodnow said it, you know, he said like they're going to lose some money from their backlog of their 90 days, and they're not starting to sell until April. So that's 2 months away that they're even going to start selling the 180 day. And then as they're selling it too, and they're not even able to transition their current patients to the 180 day until they go through the loops of insurance. So I think there's so many variables that have to go through before they fully start selling and fully start transitioning their own patients to the 180 day. So that's why he came out and said 14 and 18 million. A lot of people were really upset that he came out and said such low revenue expectations. But I actually called investors. I have a contact in Senseonics from Investors Relations that I would call them at least once a month. And I called him after this was done and asked him, like, why did he come out and say such low expectations? You know, like it has such a negative effect on the market, right? And he actually told me, you know, we don't look at it like that. We look at Tim Goodnow being honest, right? He knows that he was going to be awarded stocks and that he was going to have to sell some to cover the taxes. Now, if he knew in his heart, and he knew that there was no way that they were going to get $30 million revenue next year, and he didn't say anything, and he just let the stock spike, and then automatically they sell at a higher price and make more money. He said he felt like that's not being honest. So he said he came out and said it so that he's being transparent and honest and saying that we're not going to make 20 to 30 million. We're going to make 14 to 18 million. And, you know, right after that, the stock dropped. He got awarded stocks that sold for less. You know, he had to sell to cover taxes. So, you know, he's losing money by being straightforward, but
he shot himself in the foot. Absolutely.
But you know, they don't look at it like that. They look at it as being transparent.
Oh, yes, I said it. I said it earlier during the call itself. Obviously, and I think, in my opinion, you know where I come from. You know my attitude about such things, and I absolutely admire CEOs who can take responsibility and be transparent about things and say, well, things are not going to be as great as we were expecting, but this is for the price of actually getting better down the line. Again, look at the longer side of the curve, essentially.
People be sticking with new diabetics for offers. Yeah, absolutely. Yeah, if you're used to a certain product and you've been using it for so long, it's hard to get you to change the product, right? But at the same time, if like, so they have actually built in, if you look at their presentation, they have like a large market share where they did surveys and they found there's like 30-something% of diabetics don't even want this device. They don't want this device implanted. So getting the person to convince to actually implant this, that's the first challenge. But then the customers that actually use Dexcom, trying to get them to switch is the next challenge. I would say, like, if you have customers that are okay already using it, and you're marketing to them that, hey, this is inside, your interstitial space, so you can be active, you can still hide. I mean, you can still be active and swim and do things. You can swim with this. You can go to the gym. So there's a lot of things. There's a lot of perks where you can still live your life and be active and have your glucose monitored. I think that's a good alternative to switch from Dexcom if you have to switch the device out every couple of weeks. But yeah, and Brandon said he has some DD on Reddit on Senseonics. Yeah, so check that out if you're interested in it. I wouldn't mind checking out your DD on it. Good for kids, yeah. Yeah, I don't mind sharing any of my notes. Everything I have is pretty transparent. My fundamental analysis is here. It's baked in on this DCF, where I have there. Yeah, I'll put the link where I have the year-over-year change, and then these three here are my assumptions. Right, this is like where I say, okay, upside. I think this is how much market share they're going to get. So like right now, currently, if we go back to 2017, they had 0.0, and this is in the past, so 0.014% of the market share, then 18.039, and then 19.041. Then they had a big drop because of COVID. And so as we go down the road here, so here is like where I think in 2024, I think after this is why there's such a big change. Somebody was asking, why is there such a big difference in the base in the downside? Because on the base, I'm kind of going online what they've done historically and just keeping that increase in line with what they've done historically. On the downside, I'm saying that they're only going to get worse. But on the upside, I'm saying my assumptions on the upside is that in 2024, when they get that 365 approval, that they're going to be taking, they're going to have a big jump in market share, and they're going to have about 1.46% of market share because of the 365, because they had all of 2023 and all of or half of 2022 selling their 180-day device, which is the one they have now. So I think these 2 years are important. If these 2 years go really well and their market share increases within line of what I have assumed here, then when their 365 comes out, then this is going to be even more like accurate or more like affirmed. I'm going to be more comfortable with this upside prediction. So that's why I said that. That's why there's such a big difference there, because it's such a big assumption. And then if the 365 is successful, then to me they have a lot more upside, right? And then 2027, 2% upside. So this is like not astronomical, right? Like if I were to put something like 40% market share of the CGM, then I would say, okay, just turn off my channel and don't ever listen to me again. But this is within reason. This is a fair assumption, right? The base is what they're on pace, what they're doing right now. Downside is if they just don't do well at all. And then the upside if they're successful. So that's why I have that.
You're actually quite generous.
No problem. Yeah, it's. But the thing is, like, okay, I'm saying in 2022 and 2023 are going to be very, very important. They're 180 days, and then the 2024, the 365. It is an assumption, but I think it's realistic for them, and that's just how I don't know. I'm comfortable with that. I think another important factor is CapGuard. Yeah. I have that assumption here. So my CapEx per revenue here, I have the assumptions for that here, and then the depreciation, I have the assumptions there. What else here? Their expenses, everything is. This is a full DCF. When I'm going to invest in a company, I do a full DCF like this. If I'm just kind of like scanning through stocks and I want to do a basic DCF, sometimes I'll just do like a quick free cash flow DCF or like just a more basic DCF just to give me an idea to see if I should continue digging deeper into this company. But yeah, this is my assumptions. And I have here also like if you wanted to like when you have this in your when I share the link for this, if you wanted to make your own assumptions, you can change the percentages or do whatever you want. And you can also factor in like the WACC and terminal growth rate. Like, right, if you feel like we're going to be affected by higher inflation and interest is going to go up and you want to change, have a different assumption, you have the chart right here. It's all done for you. So you just have to look at the WACC, you have to look at the percentage, and you can kind of like follow, you know what, I think it's going to be 11 at 4%, and then click here, and that'll give you kind of like what that assumption would be. So you can do your own assumptions with this if you want it. But yeah, I'll share the link, and you guys can do whatever you want with it. Any other questions before we head off? And make sure you guys subscribe, comment, hit the like, all that stuff, all that good stuff, man. Showing the support. And I'll make a link for this, which I think I just go up here and I'll just create this as a link, and I'll put it in this live stream now on the video downstairs. Right, Greg? Right, I just go up here and I can just make this Excel sheet a link, right?
Yeah, I don't remember anymore already, but yeah, you can.
I haven't done it in a while. I'll just Google how to do it. I'll make this Excel sheet as a link.
Like in forever, pretty much.
Yeah, it's been a minute, but I'll make this Excel sheet as a link, and then I will, or here, okay, share it here. Share it here, then you have to tell me, I have to Google on how to make this a link. Hold on. Link. Add, no, I want to create.
No, you need to essentially save it as a page, and then you can put it as an address, something of that sort, if I recall correctly.
All right, yeah, I'm gonna have to figure it out. I'm gonna do the research. So please could you tell us more about live and active Discord and active Discord? I don't have any active Discords. What I do, I'm actually in March. I'm starting because I every Saturday I go live, and I do a full class for people interested in day trading and swing trading, because that's where my career started. I've been day trading and swing trading for like 10 years, and I worked in management, and then I went back to school to become a financial analyst, and I got my degree, or finishing my degree in financial analysis. But swing trading and day trading was kind of like my foundation. I did that for like a decade. So I put together a course which I teach for free every Saturday, and you can join. But that's all I do. And then in March this year, actually, and probably in the next week, I'm gonna like go live and day trade live maybe once or twice a week, just for the people, because I have some people that just want to learn how to day trade. Other than that, yeah, there's a link in my description, but not for the course. But not for this DCF, which I'll figure out how to get a link, and I'll put it in these on the bottom of this live once it's uploaded on YouTube and stuff.
But yeah, just upload the file to Discord. They're correct. Why not?
Yeah. OG. Oh, here we go. OG came through. To make a link, I believe you have to go to File, Share, Save on Drive, and Link. File. Yep. Share, save on drive, I have saved to cloud.
You can, that actually is a way. You see, I told you it's roughly something like that, but depends what you want to do.
I'll share with people here, I guess.
Share with people. If you no, that's with like your people, so it's not gonna help you. No.
Email.
OG, what's your advice? OG will know better, or will be the better way, depending on what you want to share.
Make it link through the cloud.
Yeah. Yep, as I told you, something like that. Roughly what I described.
But make it uneditable. You can. No, this ain't it. You could you can save the file and upload it to Dropbox, then share the link. Okay. All right, so all right, yeah. So I'll get with OG and I'll figure out how to do it. But thanks for watching, guys. And we will have the link for the Excel sheet. You guys do what you want with it. Do your own research and make your own assumptions. Like Greg said, I was being too generous. So if you feel like my assumptions are too generous, for example, change it to what you're comfortable with, what you think, and then see what price target it gives you. And that's what it is. We all share information, and we do our investments based on our comfort level and what we're comfortable with, and that's what we got to live with. So I thank you for joining, and see you guys on the next video.